If you traded cryptocurrency in 2024, the IRS expects you to file a report in 2025, period. Even if you didn't convert your assets to fiat or cash out, all crypto activity, from staking and yield farming to token swaps, can trigger a taxable event. The IRS has intensified its efforts to monitor blockchain transactions, matching wallets and exchange records to taxpayer IDs. And with more exchanges now required to issue 1099 forms and disclose user data, non-compliance is no longer an option. Here's how to avoid the most common tax mistakes and stay compliant this year. Most common crypto tax mistakes. 1. Forgetting to report wallet-to-wallet transfers. Many traders assume that transferring crypto between wallets is a non-taxable event, and that's technically true. However, failing to track and log these transfers can break the chain of record keeping. Without tracking the source, cost basis, and destination of assets, you'll be unable to prove where they came from, which complicates capital gain reporting. What to do? Always document the date, amount, and wallet addresses involved, even if the transfer itself isn't taxable. This keeps your cost basis and transaction history accurate. 2. Misclassifying staking rewards or airdrops. Rewards earned through staking, liquidity mining, or airdrops are considered ordinary income, not capital gains. These must be reported at their USD fair market value on the day you receive them. Many taxpayers fail to report these assets properly or confuse them with non-taxable deposits. What to do? Track the exact time and USD value of each staking payout or airdrop. Include them on your tax return as income, usually on Schedule 1 or Schedule C, depending on your activity level. 3. Ignoring losses from DeFi rug pulls or token collapses. If you invested in a project that turned out to be a scam or suffered a rug pull, you may be eligible to report a capital loss or worthless asset deduction. However, many investors skip this step, either because they don't understand how to report it or they believe it's not worth it. What to do? Consult with a CPA who understands crypto. These losses can often offset gains or reduce your taxable income. The event must be documented and justified as a capital loss or abandonment. 4. Failing to track cost basis across multiple exchanges. Crypto traders often use multiple platforms like Binance, Coinbase, Kraken, and decentralized apps. When you sell a token, the IRS expects you to know how much you originally paid for it. This is your cost basis. If that data is missing, they may assume a basis of $0, which inflates your taxable gain. What to do? Use crypto tax software or work with a CPA to consolidate your trading history across all wallets and platforms. Cost basis tracking is essential for Form 8949. 5. Believing offshore wallets and exchanges are invisible. Some traders still think that keeping assets in offshore wallets or on foreign exchanges makes them invisible to US tax authorities. That's a myth. The IRS partners with FinCEN and has international agreements to monitor foreign accounts. If your offshore activity is discovered and not reported, you may face penalties for failing to file FBAR or Form 8938. What to do? Disclose offshore holdings and earnings honestly. US citizens and residents must report worldwide income. Crypto held in foreign accounts may require extra forms, even if you didn't sell. What the IRS expects in 2025. The IRS expects you to track every crypto transaction, buy, sell, earn, transfer. Convert every transaction to USD value at the time it occurred. Report crypto income, staking, mining, airdrops as ordinary income. Report sales of assets on Form 8949 and Schedule D. Report foreign accounts on FBAR and/or Form 8938 if applicable. This applies to all traders, even hobbyists who exceed certain thresholds. The smart way to handle crypto taxes. Crypto accounting is not just about using software. Software alone can miss gas fees, LP tokens, or complex cross-chain swaps. That's why CPA guidance is essential to make sure your final tax return is accurate, defensible, and audit-proof. At Fast CPA and Consultants, we offer full crypto transaction reconciliation, cost basis and gain loss calculation, staking and DeFi income categorization, offshore asset reporting and FBR preparation, tax return filing for US and non-resident clients,